Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Senthil Manikandan of Newberry Capital, independent expert Dharmesh Kant and Vinit Bolinjkar of Ventura Securities joins us. Vinit is running a little late, but he'll join us on the show. Today on Hot Money, we'll discuss stocks like Escorts, Dilip Bilkon. We'll discuss the two-wheeler space and also Canfin Homes. So the first stock that we want to speak about is Escorts. The counter has been doing well of late. Yesterday was one of the top gainers, continues its good run. Post very strong March sales numbers that came in. Total sales were up 66%, domestic sales were up 65%, and on a year on a whole, they grew by almost 26%. So the question that we are asking is that will the rally continue for Escorts going ahead? So Dharmesh, what's your view on Escorts? Will the rally continue?
I think next 10-15% of move can still be there on the stocks. We're seeing the kind of momentum the stock is into, and the numbers have been really good. They have been able to outbeat their peers in the same space. The main turnaround in the Scots has been the 4 good years of monsoon which has been there. Going forward, if the monsoon this year is also good, the numbers should likely to be so. But let's not forget, they are now coming on a high base effect. So this 50% kind of a growth or 60% kind of a growth may not be there. 20-25% is the likely traction in the volume numbers. And to that extent, I think the valuations are now getting into a stretched zone. So 10%, 15% more up move, and that should be the end of the Scots rally which we are seeing on the valuation front. Because even if you take 25% compounding, it's trading at 22-23 times FY20 earnings. So that's way too expensive for a company whose margins are low, single-digit margins are there, return ratios are in single-digit, and input prices will be higher up going forward.
Okay.
So it's a avoid for me now.
Okay, what about you, Senthil? Will the rally continue on Escorts going ahead?
So like Dharmesh mentioned, this year has been a fantastic year for the company and the industry as a whole. So for FY18, tractor sales is industry-wide has grown around 17%, and for Escort, it will be around 18-20% kind of growth. But over next 1 year, I think next 1 or 2 years, this sales will taper it down to high single-digit kind of growth numbers. But what you are seeing positive from Escorts is that what are the products they launched in the last 3 years has been a bit of a high margin, and also we have seen stupendous growth in the EBITDA margin level. 3 years back, they used to do around low single-digit kind of EBITDA margins. Currently, they are doing it around last 2 quarters. The EBITDA margins have been in around 10-11%. Going forward, we expect another 150 basis point improvement in the EBITDA margin level. And their construction equipment business and railways should grow well in the next 2 to 3 years. They have a good order book coming in the railway segment also. So we are a bit neutral to bullish on the stock.
Okay, what about you, Vinit? We're discussing Escorts. It's at almost new highs. Will the rally continue post strong sales numbers?
So recently the management had guided for growing revenues by 20 to 2.5x. So if you have to grow that, you have to grow at a substantial growth rate, than what the analysts are factoring in. So FY20 we are looking at about 18 times multiple. But I think that they will do better than this if they have to meet their FY22 this thing. So they're talking of doubling doubling tractor numbers, improving market share by about 5 to 6% from 11 to 16%, and growing exports from 5x, from 2,000 to 10,000. So that's a leap kind of aspirations. They've put power track and farm track in all the other markets. They've launched an electric tractor. They've also got into little gizmos around pressing a SOS button if a farmer needs help, and having an app for putting the tractor on rent. So these are very dynamic marketing strategies that are in place. That is one on the tractor side. Railways is doing very well. They've got very strong engineering, and construction, as we know, with Bharat and all going up. So
okay,
I think, yeah.
Okay, your time is up. I'll throw it open for discussion, and we'll come back to you on what you were continuing. So railways, you're going back. The management has given a vision of 2022. Do you believe that it could be possible? What are the possible tractors in such a competitive market? And in a scenario where they're dependent on monsoon, will they be able to meet that?
So they're trying to decouple from the monsoon also a bit. They're getting into white spaces. So south and west are weak markets for them. They're getting into that space. And these efforts are playing out. 2 years back the stock was $100. Today it is 10x. So that 1.0, if we call it re-engineering, has worked. And this next thrust is there because they have got the market share now, and they're getting increasing acceptability. And we are, and what is happening in the market is, if you notice, is it is becoming a winner takes it all kind of market. If you see Titan, I've been speaking to a few players in the industry, they're wiped out. They don't have sales. Their layoffs are happening even now. I know somebody who got laid off very recently. So the winner takes it all is my mantra. So what is happening is, people with strong business models, strong product, and strong distribution are now going for the the kill. So it will become increasingly a very polarized market where you have strong players and very weak.
Dharmesh, do you agree with certain points that they obviously the counter has become 10x, they have managed to come up in this thing, they have an aggressive vision, but do you think that they will be able to achieve such a vision? And obviously M&M is a big competition also for them, so in a competitive market, do you think they will be able to grow?
I have my own doubts about the vision of the management, because the thing is, with all this rental and concept of things coming to the play, you won't need more of a tractor sales. It would be same asset can be utilized more efficiently and effectively. So all these things will play out in a big way. And as more and more land consolidation happens, you need fewer tractors. I mean, few farmers can own and the entire area can be cultivated. So these things are actually working on ground. It's not for the sake of saying. Actually, if you go and check, so this is what has helped in the efficiency of the farmers. So having all these things in mind and 4 good years of monsoon, so one bad year and things may turn around, and input prices are on the higher side. So realistically speaking, 15-20% growth is feasible.
Nothing beyond. And Santil, you said that you expect 150 basis point margin improvement. Very quickly, what's the rationale and how do you see that happening?
So basically on the product mix side, if you see the FY18 sales, around 75 to 80% of the product sales came from the products which they launched in the last 3 years. And the company has recently launched compact tractors in the 20 to 30 HP category, and also they are actually a paddy specialist tractors. I think this product mix is going to drive the margins levels, plus also the operation level. They have really curtailed the inefficiency in the last 2 to 3 years. So from 4.5-5% EBITDA level in FY 15-16, they have come up EBITDA level of 10 to 11% in this quarter. I think going forward, 150 basis point could be over the next 2 to 3 years is feasible.
Okay, so I think that's the consensus view that we're getting in on Escorts. Two of our guests do believe that it's a good time to start accumulating. It should rally. Dharmesh here is a little conservative on Escorts at this point of time. The next stock we want to speak about is Dilip Buildcon. The counter has managed to rally. It's almost at lifetime highs. Couple of positive brokerages also coming out. It's another up 4%. Will the rally continue in Dilip Buildcon? We are asking our guest. So Senthil, I'll start with you. Do you like Dilip Buildcon?
So we are neutral on the stock currently because it has run up quite a bit in the last 1 year since listing. We like the business model of the company because they own all the equipments, and compared to the other players, they don't subcontract the work. So because of that, they are able to complete the projects pretty much early, and they get the early completion bonuses also. So this is one thing which is unique for this company. And as we are seeing the road contracts in the AM, there is a lot of contracts coming up with the NHAI. So industry-wide, there is bullishness in the getting the contracts. So we have to see how the execution is going to panning out. And since the stock is trading at around 23 times, 24 times this year's earnings, I think there is little amount of margin of safety currently present in this stock. So we are pretty neutral on the stock currently.
Okay, what about you, Vinit? Do you like Dilip Buildcon?
So the sentiment is very bullish, so the valuations will remain. I see about 10 to 15% more upside, but not too much. I think the valuations are demanding.
Valuations are demanding on
because if you see their earnings over the next 2 years, margins are going to compress about 300 bips, and your EV by EBITDA multiple, which is around 7.5, will go out to about 8.5 in FY20. So valuations normally when you forecast, they should tend to get cheaper, as you go forward. But here the EV is rising. And second thing is they've taken on so much, they've built up their books so aggressively, they will have to deliver or they will have to subcontract. Because too much on your plate, execution is a challenge. They've done it, but you know, when you've taken off so much, you've won so many orders of late, that you know, executing that will be a challenge.
Okay.
So considering the valuation and the execution risk, and little bit of leverage going up, I think it's a momentum play.
Momentum play. Okay. And what about you, Dharmesh, Dilip Buildcon?
I think it's a good investment play as far as Dilip Buildcon is concerned, because if you look at what they have done it rightly is falling into EPC and HAM models. So all the road construction companies which went into BOT model, so they all failed because of the, not because of their own problems, but because of the procedural problems which were there. Lack of orders, lack of clearances, all time delays added to the balance sheet woes. So Dilip Buildcon has been right on the business model from the day one. They have been only getting to EPC and HAM kind of the recent award, which was 1,000 crores from MP government, is again a hybrid annuity model kind of a contract they have got. So that works well for the company. I don't think leverage is too high. Leverage is okay, good enough. 1.5, 1.6 times debt equity is fine for any road construction companies. Margins are decent and their return ratios are quite aggressive in the same space. At the same time, return ratios are good. I do think this momentum with the government impetus will continue. So it's a good investment. Right?
So I think it's a momentum play what our guests are talking about. So we'll throw this open. Vinit, you spoke about 300 basis point margin compression. On what basis are you saying this?
So because you're getting into EPC and HAM, so there the competitive bidding has brought down margins a bit. So we'll see that taper off a little bit.
Okay. And what about the order book? Because they've taken up so much, do you think, and that probably comes at the end of the year. So in fourth quarter, you always see lots of orders coming in. Do you think that now for a period of at least next few months, it will be a lull period in terms of getting new orders for Dilip Buildcon?
No, I think it's an ongoing process. The government will keep awarding. Okay, so as and when the land parcel 90% is accumulated, the government North will keep on bidding out.
Dharmesh, what is Dilip Buildcon doing so right that it continues to get so many orders and it is ready, is able to execute it much faster and before time than rest of the other infra players here?
So the type of orders they are getting. Basically, it's his HAM and EPC, and as Vinit pointed out, 90% of the land clearance. So that was the only bottleneck. If you look at any construction company, none of them suffered from their own execution capability or the wrong intention. It was, the point was, after the award has been given to you, land was not there, forest clearance was not there. Things like that led to the delay in execution, which added to the balance sheet problem, which is not there. So they were a late entrant into this field aggressively, and that has worked well. So I think this is what would be the turning figure. As far as execution is concerned, there is no dearth of labor. They are the largest equipment players in the construction division. So that won't be a problem to my mind. So that should keep going.
Okay, so I think that's the view that we are getting in on Dilip Buildcon. We'll move on to the next stock rather than the next sector. The auto sales numbers have come out, and all the two-wheeler companies have reported robust set of numbers. Hero almost was 7.5 lakh units were sold within a month. So there is traction that's been seen. We are asking our guest which is the best one out of the four listed two-wheeler space that they like. And Dharmesh, out of the four, which is the best play in the two-wheeler space?
I still like Hero.
Why?
Because of the consistent performance over the years, and their presence into segment of 125 cc. So that has been working out well. They have been able to diversify themselves from motorcycles to scooters as well. So like a few years back, there were 5 lakh units, and Bajaj was aspiring to be 5 lakh units. So Bajaj is still at 3 lakh units. It has moved to 7 lakh plus units a month. Capacity is already there. And they are expanding their capacity to take care of future growth. In Chittor, Andhra Pradesh, they would be setting up a capacity. So capacity won't be a constraint, and they are foreign into third world countries where again 125 cc bikes sold. So that is also in place. Margins are okay, 10-11% kind of a margin is there. Return ratios are in excess of 30% on ROE basis, and you are getting a 13-14 times FY20 earnings multiple. So there's a lot of scope there. I think 50% kind of up move on the stock price in next couple of years should be very much on the cards, provided again the monsoons, the rural theme in India, which it works, remains there. And that is the segment where what Hero has done right is they have not deviated from the strength. They have stick to the stance. So that is what I like most.
So Hero, what about you, Senthil? Which one I think you like? Bajaj Auto. What's the rationale?
First thing is with respect to the exports market. Last 2 years, export markets have been not doing well because almost all these countries are oil dependent. So this year, export markets really started firing on that front. And we are seeing in the Q3 numbers also it was good, and Q4 sales numbers, we look at volume growth of exports outpace the domestic motorcycle growth. Second one could be the three-wheelers. Three-wheelers, we saw a couple of states delicensing and giving up new permits, and we expect three-wheeler sales to grow in the next 1 year or 2 years, and management also expects a couple of new states to give new permits for the three-wheelers category. And coming to the domestic motorcycles, the company has relaunched its new Discover, and also they are focusing on the CT and Platina. And company in the, I think yesterday the management meet mentioned like their demand for CT and Platina was outgrowing their own expectations.
Okay.
And another optionality in the stock is with
respect. Your time is up. I'll come back to you. And Vinit, you like iShares, so I think we have a full all three different views. So iShares.
So iShares, I think it's one company which fills up capacity the moment the capacity is pulled up. So they've got so much innate confidence on selling stock, and now they're focusing all their energies on marketing and on distribution. So they're adding 2 to 3 dealerships every week. They're going to launch 5 brands, and their playground is not just India. They're going overseas. They're doing more experiential shows. And just to draw a highlight between Hero Honda and iShares, in FY20, Hero Honda will do over 40,000 crores of revenue and with about 40 and 100 crores of PAT. iShares will do 12,000 odd crores of revenue with 3,600 crores of PAT.
Okay.
So this kind of that growth rate which is there, the value and the margins that they're getting is just phenomenal. Their margins have been going up. Hero is at 15%. They are at 32%. Okay, both have got good ROEs, and we have a good timeline toward expansion.
Okay, so your time is up. We'll come back to it. So basically, on Hero, I think the issue is with low margins. So they haven't been able to get that margins going ahead. So is that a concern that you have? Because they're growing mainly on volume, not on value, as he pointed out, that others like Royal Enfield and Bajaj have much higher margins. No doubt the return ratios are similar. So is that not a concern?
So to my mind, margins does not matter as long as you are making the profit, and the market cap is a multiple of profits which you get. So return ratios are fine. On the equity, ROE, ROC is concerned. If you look at the balance sheet, cash flow, everything is fine. They are into a volume game and they are into a premium segment game.
Okay.
So that's the reason for the margin difference. So how does it matter if you make 20% or 10%? As long as you are making more absolute profits than the other, you should be getting a more market cap.
Okay.
So my point is that. And if you look at Bajaj Auto, where they have been successful, they have been successful into 125cc bikes even in Middle East countries. I mean African countries, the third world countries where they are marketing. So again, the premium segment, iShares has been able to capture that market very well. But let's not forget TVS Motor, let BMW bike come. Then we will see where iShares stands after that fierce competition, because those bikes will be much cheaper than if you are importing.
You want to respond? That's a valid point.
Yeah.
No doubt TVS is overvalued, but
so
if BMW
so
comes
I think once BMW comes in, the competition accelerates and the market grows. Right now it's a duopoly. Little bit of Bajaj, little bit of Harley Davidson. Okay, but as I said, the international market is about 1 million bikes. Okay, and these guys don't have any share there, and their products are really getting appreciated in the 600cc category. Okay, so I don't see, to my mind, that competition coming in will kill the brand for Royal Enfield.
No, because the thing is that initially it was playing on low capacity because there was no capacity. The supply, the demand was much higher than the supply. Now with excess capacity coming in, that's not the case, and the base is also growing high.
There is no excess capacity.
Okay.
So today you are selling 8.4 million, 8,40,000 units. Your capacity is there. Next year your capacity FY19 will be in 9,60,000. You are already going to hitting that.
Okay.
Okay. So you're going to do the next phase of expansion. So what I'm trying to say is, when you put up a capacity, okay, it takes 3 to 4 years to sweat that asset. Here I'm sweating the asset from the very year that I get occupational.
Okay.
So this kind of growth margin expansion, 5 new products coming in over the next 5 years. Okay, and they were very fungible platform for the new twins 600cc bikes that they have. So they are very fleet-footed now.
Okay. And Senthil, on Bajaj, just a couple of things. First of all, export markets are not growing. There are concerns in some of the markets that they have, and they don't have any presence in scooter. Is that a concern that you are having on Bajaj?
So if you look at the industrial automobile market, those who garner the market share, being the major market share, will remain the value creator. It's like Honda entered the scooter market, they still remain the market leader. Hero in the economy, while Bajaj, they created a sports segment and they are still the market leader. So those who are creating the segment will continue to remain the market leaders. So not being in scooters is a drawback for Bajaj, but the management is focused on the motorcycles.
Okay.
If you see the pre-Bajaj KTM tie-up, KTM was doing around 65,000 units per year. But after the Bajaj tie-up, now they are doing around 4x of that units. And if you look at recently they are tied up with Triumph. So with this Triumph partnership, they will be entering the mid-weight category. So currently it is dominated by the Royal Enfield. So I think this partnership gives optionality for Bajaj to garner market share in the mid-weight category also. So
okay, so I think we got diverse views on all the companies. So Hero is something that Dharmesh likes, Bajaj is something that Senthil likes, and Vinit likes Royal Enfield Eicher at this point of time. And the final stock that we want to talk about is Canfin Homes. The counter has corrected 20% from the recent highs as the stake sale didn't go through. Is this the right time to accumulate? We'll ask our guest. So Vinit, will you accumulate Canfin Homes?
Yeah. So it's a no-brainer that RERA has been hugely successful. The number of players in the market has collapsed, okay, but demand has not gone away, right? In fact, we are seeing a very strong pickup in demand, especially in the affordable housing space. So Hubtown has put up a small scheme in Andheri, 325 square feet apartments, okay, 90% booked. They put an ad that's 700 footfalls on inquiries. So this kind of traction that you're seeing in the space of affordable, and I think the loan growth will sustain. 25-28% is very possible, and at 2.5 times FY20, I think it's pretty fairly valued. You have got ROEs upwards of 20%.
Okay.
So a price to book multiple of 2.2, 2.3 is pretty okay.
Okay, what about you, Dharmesh? Will you buy Canfin Homes at this level after this?
No, even after the fall, it's way too expensive. So like on a TTM basis, it's trading at 5.5 times price to book. I have much better place in the same. I am bullish on the housing finance segment, no doubt about that. So there is no two thoughts on that. The only thing is which company and which stock to buy in the housing finance segment. So Indiabulls Housing or DHFL, even LIC Housing Finance look much better today. So just on the valuation metrics and the same or better type of growth, like Indiabulls Housing will give you a 30% plus kind of a growth with a better ROE and a better ROA. 2.8 times is the ROA of Indiabulls Housing Finance. Can finish 2.1, 2.2 times ROA. ROEs are in excess of 30%, it is in 20%. So, and it's available cheaper at 4.5 times price to book on a TTM basis. So, why not Indiabulls Housing rather than a Canfin Homes?
Okay, so Indiabulls Housing Finance is something, and what about you, Senthil? Will you buy Canfin Homes at this level?
yes, I think so. Because if you look at the Canfin Homes, they are focused on the salaried and professionals. Around 70% of the loan book is comprised of the salaried and professional segment. And they are able to maintain the NIMs because efficient sourcing of funds. Their cost of funding, if you compare with the other peers, it's around 30-40 bips lesser. And their cost to income ratio is lesser than compared to the peers. Around 12.5% is their cost to income versus the industry average of 15 to 23%. It varies. So I think these two things makes Canfin Homes a better play. And their average, if you look at the loan size, also is around 17 lakhs. So they are having a good sweet spot of their affordable housing demand. And actually the deal didn't go through, but the business fundamentals still it's intact. And I think the current valuation seems to be higher on a trailing 12 months basis, but we see tremendous growth from the affordable housing side also.
Okay, so I think two of our guests do believe it's the right time to start accumulating. So very quickly, Senthil, a report that I was reading said that fourth quarter probably will be very weak for Canfin Homes, given that all the focus was on the divestment and that didn't go through. Is it possible that fourth quarter will be weak?
I think so, because As you mentioned, the management focus was much on the deal making side, could be. But when you look from a 1 year or 2 year perspective, I think the business fundamentals is still intact. They are pretty much focused on the south. Around 70% of their book is from the southern market. And as I mentioned, their focus on the affordable housing and the demand layers still intact. But this deal making was a little bit distraction from the management side.
Okay, what do you think that fourth quarter will be weak? That's what I was reading in a report that came in.
We don't track it too much on a quarter-to-quarter basis, so I'd reserve my comment on that.
Okay, so I think that's the view that's coming in on Canfin Homes at this point of time. Both Senthil and Vinit believe that it's the right time to accumulate. Dharmesh prefers Dewan Housing and Indiabulls Housing Finance rather than Canfin Homes at this point of time. But with that, it's a wrap on today's Hot Money. Vinit, Dharmesh and Senthil, thank you so much for joining me on this show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.